Now, if you were hoping for interest rates to cut in 2024, you're probably in for a nasty surprise. In this video, I want to talk to you about the latest inflation data that just dropped yesterday and why it could have major implications on you as a mortgage holder, or if you're currently renting, it might be about to get worse. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, I do run a full service buyer's agency, and if you want to know what happens behind the scenes, then definitely go check out this video. It's our first ever vlog, and we're going to be trying to do this weekly, if not fortnightly. We just want to provide more insights as to what we look at when we're buying property, researching what the team's like at Search Property, because we now have over 30 full-time staff, which is really exciting. I want to take you guys along the journey as we document the whole thing. Now, there's been ongoing speculation for the better part of the last 2 years around inflation. When is it going to calm down? And we're probably at the end where we can now start seeing interest rates cut. We've already got talks of the US trying to cut rates in the back end of 2024. We've also got some countries starting to implement cuts now, and that is probably a sign of things to come here in Australia. We saw the exact same thing play out when interest rates started hiking, and some went out of the gate really fast. Some central banks increased it in a shorter period of time with higher interest rate hikes. And then there's others like Australia that started implementing rate hikes of about 25 basis points, whereas the Fed was pretty much doing 50 basis points all the way through. Now, why is that important and why do we need to know it now when we're looking at Australia? The reality is the global central banks pretty much dictate what happens around the world. Now, everything is not linear and everything does not move at the exact same time. So keep that in mind as we go through this video, because just like any other asset class, when you're looking at the prices, if you're to stay in the short term and look at the data day to day, you're going to find there's so much volatility. And if you're making long-term decisions on short-term metrics, you're going to get wrecked. So let's look at a couple of things as to why the interest rates may not be cutting here in Australia, and what does that mean for the Australian housing market? A higher than expected inflation number has dramatically raised the risk the Reserve Bank will be forced to hike interest rates again to get consumer prices under control. The ABS measure of consumer prices for May showed a rise in annual headline inflation from 3.6% back to 4%. And we know the Reserve Bank has a target between 2 and 3%. Asia Pacific economist of Indeed, Callum Pickering, said the data would give the RBA a lot to think about at their next meeting, which will take place in early August. So if you're watching this, we're probably at the end of June, and that would mean that we still have pretty much about 6 weeks before we have the next RBA meeting. In that time, we're going to be able to capture a lot more data. With inflation already at levels that are uncomfortably high, we believe that Australian households and businesses need to prepare themselves for another rate hike. Now, if we were to zoom out and look at the monthly consumer price index indicator, we can pretty much see that the RBA is looking to get inflation between 2 and 3%. And that's pretty much in this gray here. We haven't been at these levels since 2021, early 2022. And since then, we saw headline move in excess of 8%. Now, what's important is you see the blue line and you see the red line. The blue line is the headline CPI, and then the red line is CPI excluding volatile items and holiday travel. Now, this is the one that we want to focus on. Why? Because you can always have months where there's certain things that are abnormal. And what you want to do is not just base decisions on abnormal activity, you want to be able to smooth out that data so it gives you the real accurate reading over a long period of time. It's the same as if you were to go into any property market and you saw one specific metric that was completely out of whack, you would pretty much disregard that and then take all of the other basket of indicators and get a weighted average. That's what we're doing here. And what we can see is that although headline goes up and down every single month, the CPI excluding these volatile items have a more clearer trend. And what you'll see is that we've pretty much been on a downtrend since early 2023. Now, that's about 18 months of being on a decline. And what we've seen over the last 6 months is that it's starting to smooth out. It means that inflation is being stickier than normal. Now, although this looks really bad on the front end, it actually could be a good thing, because what we want to do is see this actual weighted average level out. So it's just going in between the bands of maybe just above 2 and 3%, and then enter 2 and 3% occasionally to then just be maintaining itself. What you don't want is to see extreme volatility. And what you see is we were at headline inflation being at minus 0.2% in early 2020, obviously due to the lockdowns. But then only about 2 years later, are you sitting at 8%. That's what we want to now compress. And that is when we get an economy that's just growing and it's sustainable. And that's when you don't have the central bank as well as the government stepping in with really volatile policies to try and fix something. It's like the rubber band effect, right? When you start pulling one way too hard, when it flings back the other way, it then causes a lot of damage. And that's what we're starting to see here. When interest rates dropped so dramatically due to the lockdowns, we saw inflation come after that. And then what we've seen is the RBA increase interest rates so dramatically that now we're starting to see inflation go down. However, this is very pivotal as to what moves the RBA makes next. And why it's important to not just say, oh, well, inflation's higher than the target band of 2 to 3%. That means rate rises are back on. I'm sure at this point, you've probably heard every news outlet come out and say, well, inflation's high. That means interest rates are going up. And I think it does nothing more than scare people like you and I. But the reality is that you can't just look at inflation and say, that's what we're going to base our decisions on. What you need to look at is the wider economy. Because a lot of these problems that we have when it comes to CPI, which include things like rent, could be alleviated by lower interest rates. And what I mean by that is people aren't willing or unable to take on loans to go and build new homes because it's simply unaffordable. So if your income isn't there to allow you a borrowing capacity to go and construct a home, you're saying, well, I can't construct a home, I'm going to go rent. And if that's another person entering the rental pool, that means rents go up and it means there's less supply on the market. And if you've got less supply, demand goes higher, which means prices go higher. And that price goes into the CPI and we go around in this lovely merry-go-round until we say, hey, it might be a problem now. And that's where we are right now because you've got the economy actually in a retail recession. A per capita recession's already playing out, which is effectively saying that we're not actually growing. The economy, while it looks like everyone out there is at the shops and shopping, what you need to look at is how many people are carrying bags. Are they actually shopping or do they just have nothing better to do and they just want to go for a walk at the actual shops? I think what we're seeing, because I'm weird like that and I sit there and I observe people, I've noticed that 6 months ago, there were a lot more people walking around with bags, shopping bags, and going into the actual stores, walking out with bags. Whereas now, we've got a lot more people just walking around and doing window shopping. And that is the concern, is that if inflation is starting to level out, it's important we don't have a rash decision made by the RBA. Now, some people might sit in the camp of saying, oh, well, I would love interest rates to go higher because property prices will crash. Then there's others that hold property might go, well, I want interest rates to get cut so my property asset value can go higher. Now, I believe there's an opportunity in either of those markets. So although I hold a lot of debt, I would love to take on a lot more debt if interest rates were lower, but I also would love to buy a lot more assets that are undervalued given interest rates are higher, which means most people can't enter the market. So I'm pretty much in the middle here. If the interest rates go up, I survive and I'll continue doing what I need to. And if the interest rates cut, then you better believe that prices will go higher. And it pretty much means I need to adjust what my financial plans are, but my passive income goes up. Now, not everyone is in that scenario. And that's why you need to prepare during these times of mass distractions. I'm not saying mass destruction, I'm saying distractions, although they probably mean the same thing at this point. Now, to showcase how bad the situation is, apart from inflation being a little bit higher than expected, is look at a couple of these graphs. This is household disposable income, and this is broken down as per capita annual percentage change. What we can see is in the red, we've got the US, we've got orange being the OECD countries, and then in the blue, we have Australia. And what we can see is that we've been pretty much on a downtrend since the start of 2020. And this is a real cause of concern because all of the other countries around the world are pretty much going the opposite way with a V-shaped recovery post 2022. So what does that mean? It means that a lot more people out here in Australia have a lot less to play with when it comes to disposable income. Now, this is national real retail turnover, and this is done by Deloitte economics team. And what you can see is that we had a moment where we went negative in 2020, again, due to the lockdowns. We saw another moment in late 2021, and we found ourselves not just here blipping through for a moment, we've actually been here for a while. And I'm going to estimate based on this, it's pretty much been for about a year at this point. And although the forecasts look like they're going to improve, we want to be optimistic, but the reality is if interest rates stay where they are right now, the retail money will bleed out. This is what happens. When you have interest rates go up, it's more expensive for retail to go and purchase something. And if sales drop, then it will force unemployment to go higher. That will cause further pressure on retail spending, and it would fall even further because, again, if you don't have a job, you're probably not buying Chanel handbags. And as I mentioned, one of the biggest attributes towards the higher inflation is rental growth. And we've seen rental growth out of this world. Rental demand has increased as home ownership has declined because people can't get a loan out there with interest rates being so high. Now, yes, for the few of you that are going to jump into the comments as I've just said that, they're like, hey, interest rates aren't that high. Interest rates were so much higher before. We'd probably just come back to normal terms. And yes, you're right. If you looked at long-term averages, you'd be correct. However, a lot of people that have become home owners in the last 10 years have never seen those days. And in fact, if you've bought a house in the last 5 years, the average interest rate is much, much lower than where we are right now. So it's all relative. If you've bought a property and it was 30 years ago and interest rates were at 15%, it's not as applicable right now because house prices were also like 10% of what they're worth now. What we can see here is in the red, we've got the annual dwelling approvals, and in the black, we've got cash rate inverted. And what that effectively means is as the cash rate goes up, which in this case is down because it's inverted, we actually see dwelling approvals fall. And that's happened every single time. So until we see the rate cuts actually occur, we're probably not going to see more dwelling approvals come into the picture. Now, the final point I'll make here is if the approval comes through, it'll most likely take about 12 months to then build those homes. If it's a unit block, it's probably going to take 2 to 3 years since that actual supply comes onto the market. So, as long as interest rates stay at these levels or even increase, you will not see the top of this market. If you're waiting to see when this market's going to crash, you're probably early because we still have that last bit of the cycle to run up. And that will only occur when liquidity comes into this market, and that will come in the form of interest rates being cut. At that point, we then see approvals increase. After that point, we see supply increase, and that is when the top of the market occurs. So this will be the precursor for when you can time your exit if you decide to sell property and not witness some sort of property crash. Again, if you are new here, smash that subscribe button. If you've been watching but haven't subscribed, you should probably do that too, because I want to provide you updates as to when is going to be the right time to buy, when is the right time to sell, and everything in between. I hope you've enjoyed this video, and I'll catch you guys in the next one. Thanks, guys.